Hello, everybody. I'm Ryan Lightfoot-Amanoff of Kepler Trust Intelligence, and it's my pleasure to welcome you to the final presentation of our discount series of webinars. Today, we'll be focusing on a topic that many of our listeners and watchers will know very well, the UK. The issues surrounding the UK, sort of politics to economics, will be familiar to most of our audience. Both our presenters today believe that the negativity in the headlines means there's a huge number of opportunities, especially those towards the lower end of the market cap spectrum, that have been overlooked. Joining me today is Jonathan Brown, manager of Invesco Perpetual UK Small Companies, and James Henderson of the Henderson Opportunities Trust. Gentlemen, thank you both very much for your time today. For those of you who are new to this event, firstly, welcome. It's a pleasure to have you. The format will be that each manager will give a short presentation of their trust for around about 10 to 15 minutes each. And then once both managers are presented, we'll open up to Q&A. If you have any burning questions in the meantime you wish to pose to the managers, the Q&A section is available on screen. So please add it to the box. We'll collate these and put them to the managers at the end of both presentations. And now, without any further ado, I'd like to hand over to James to please take it away for your presentation for the Henderson Opportunities Trust.
Ryan, thank you very much. And it's very good to be at home doing this because I wouldn't have been allowed into the office. I tested positive for COVID this morning, and no one's going to break into this room. Everyone's decided to lock me away. So it's very nice to be doing this. Thank you. Henderson Opportunities Trust is a mixer in portfolios. Me and Laura do some big company funds like Lauder Venture and companies that are more mixed like Lowland, but with Henderson Opportunities, it's a small trust. It's 100 million, and this gives us the flexibility to go down into micro cap, to go across the market. Everything, we can look at everything, and that's really exciting. What has happened is we've been buying more and more in AIM and we're now 45% in AIM, and we've certainly been premature in doing this. The interest in AIM has fallen, but that's the opportunity. So with more ado, I'll go into the trust. So it's all UK, and it is early stage to establish businesses. We use different disciplines to look at different sorts of businesses, and we try and get a blend of these different types of business to give good growth over the long term. We do pay. What comes out is a growing dividend. If you grow the capital over time and you keep an eye on the income, your dividend grows as well. Just a little bit of history. We have to put these things in. Actually, the trust was started in 1985. I was working with Richard Smith at the time, and we launched it then. Why we say managed since 90. I've been involved in the management of it since 1990. It's had, and I'd be the first to say this, a very poor time, both absolutely and relatively, in the last couple of years. It has had strong times coming out of recession in the past. So you see the 2013 or the 2012 years, but 2022 and until about 2 weeks ago, this year, it was having a very poor time. That's AIM stocks were hurting it. The small companies were hurting it. The money leaving the UK was hurting it. But actually, just of late, and that's quite exciting, it's that area that's actually leading the bounce up in the market. Then how do we run it? We're blending large, medium, and small companies, and I'll just go into each of those areas at the moment. The early stage companies, they've been sold off badly in the UK. People don't want to take anything on trust. No one wants to pay for any blue sky. Yet within the UK economy, there are some very exciting early stage companies. They will be companies that grow in time and fuel our economy. Some of them are spin-outs from our universities, for instance. What we're doing there is we're taking relatively small stakes in them, and we're adding when we see them develop. I mean, some of them are already going a long way. Something like Oxford Nanopore has become a relatively large company. These are companies that aren't attracting investor support very much at the moment, and so we're looking very closely at these companies when they've got a fundraise on at the moment, because there's a lack of interest in there. Therefore, there are real opportunities to be getting them at buying into them at really interesting prices. The next sector of what we call the tomorrow leaders are genuine growth smaller companies. These are companies that have already got through the early stages. They are growing, they're maturing businesses, but they have real good growth characteristics. But they will carry some risk. There will be cyclicals in there. Then our compounders, our medium and small cap compounders, these are the stocks that are coming through year after year with good results. An example would be something like Traxys in there, and I'll go into that in a minute. And then an area that we are spending a lot of time thinking about at the moment is the recovery section of the portfolio. There are stocks that have been, both in share price terms and operational terms, had a very challenging period. The valuations down there are low. If we have a little bit of economic recovery, companies that have really focused and reduced their costs will, when a little bit of top line comes through, see very good operational margins come back. It is on the recovery in the economy. It will be that box that could have some spectacular returns. So that's the tomorrow leaders side, and then we have the stabilizers. These are companies we keep with through the cycle. They are the maturer businesses that hopefully take out some of the extreme movements that can happen in a slowdown about tomorrow's leaders. We also have an exposure to natural resources, because a lot of these companies that we have on the left-hand side will be energy users. They will, on a hike in oil prices, suffer a bit. So we always have this natural hedge of looking for natural resource companies that will be counter-cyclical on an oil price rise, particularly. So how do we break at the moment? So that stage, early stage companies might only be 6% of the portfolio. Certainly takes up more than 6% of my time, because these companies, there's a lack of research written on them, and the lack of research is part of the opportunity. That recovery in special sits at 16%, that will be grown. We'll be reducing that 25% in the large caps to finance the growth in recovery stocks. We are 10% geared, and that might creep up too. But so it's that dark brown bar will be going up, and as will the three orange bars, when we'll be financing it out of that large growth element of the portfolio. Just a few examples of things we're buying. When in a slowdown like this, in a difficult market, what is important is diversification of underlying holdings. We run relatively long lists, so there's nearly 100 stocks in the portfolio. This allows us to be bold. We're buying early in some small companies, and we will have small cap failures. But that's the privilege of a long list. We want every company to succeed, but if you're being bold, you will make mistakes. I was always told that it's rather like playing tennis. If you never serve a double fault, you're not trying to hit your serve hard enough and the second serve hard enough. So we will have, but how we avoid concentration of risk is diversification in the underlying activities. Some of these stocks are benefiting from the UK economy that is proving to be more robust than people thought. Something like Workspace. It's exciting going around Workspaces. some of their facilities at the moment. There is a real buzz in the UK in certain small companies. Boku is a great leader, is a leader in payments, phone payments. Again, an exciting UK company. And then there's those stabilizers we were talking about. Something like Flutter is Paddy Power, Betfair are in there, but more importantly, American gambling opening up. It's total different risk criteria to the UK focused companies. Let's move on. So I spent a bit of time from this presentation thinking, how am I going to show the UK's cheap? And I thought, we've all shown the P charts, we've all shown that the UK has been suffering in the smaller companies area, and it's cheap against this, it's cheap against that. How business people often value their businesses, they think, how much, when they buy a business, how much does a pound of purchase price buy me of sales? And in engineering or in manufacturing, often what you do is you think a pound of purchase, a pound of what I'm paying buys me a pound of sales. And that's often their starting point for looking at a business. And I've often found it's a really good tool to look at sales to price, because it's a very clean thing, sales number. You can always change your profit number, will be varied by your provisionings and your depreciation charges. Actually, what's the sales number is a number you can trust. And I've run something like Lowland since 1990, and I've usually using the sales number to market cap. It's usually always been around 1. And if it gets much over 1, the market's usually a bit expensive. And when it gets much under 1, the market's usually quite cheap. This time round, what we've seen it drop and drop again. And I've never run portfolios of good, solid companies where the price to book is down at 0.6. And that strips away accounting. That is a very, and the noise around accounting. That is a very clean way of looking at it. And I think that suggests to me that you could have, just on that, just to see it back to 1 to 1, you're talking about a 40% move. That is the degree of cheapness, I think, that we might be looking at in the underlying portfolios at the moment. So I think for Kepler to say I've had my 10 minutes. Very quick conclusion. AIM has been oversold. There is real opportunity in AIM. 44% of the portfolio is in AIM. The other bits of the portfolio bring a real blend of different risks to the portfolio. They're all businesses that I think should substantially grow over the coming year. So with that, I'll pass you back to Ryan. Thank you very much.
James, thank you very much for your time. That was very interesting, and hopefully you start feeling better soon. We will pass straight over to Jonathan, who one of the co-fund managers, Invesco Perpetual, UK smaller companies. Jonathan, please take it away.
Okay, so first slide, I'll talk a little bit about how we manage the trust. So the small cap sector is an incredibly diverse sector. There's over 1,000 stocks we could own within the portfolio. So a real wealth of opportunity there. So in terms of what we're looking for high quality businesses with lots of growth potential, and we're looking to buy them on sensible valuations. So it's a fairly straightforward proposition. In terms of quality, we're looking for companies that have good margins, good returns, but in particular, some means of preventing them from being competed away. So we like companies that are rich in intellectual property and specialist know-how. And we also like businesses that have very high market shares within their niche that can give them a scale advantage over smaller competitors. So they're the kind of things that we look for when we're analysing businesses. In terms of growth potential, we always say we like to find businesses that have the potential to double on a 5-year view, and there needs to be some tangible reason why, and that's either an exposure to a higher growth area within the broader economy, or it's an ability to take market share through having, you know, innovative products or some superior kind of offering in terms of service. So that's what we look for when we're meeting businesses and analysing businesses. And we do around 300 site visits and management meetings every year. So a very large part of our time is spent in a very hands-on way, meeting with the people running the businesses, visiting premises, and gaining a really thorough understanding of what these businesses do on a day-to-day basis. So a fairly simple proposition. We're long-term investors, quality, growing businesses, but we don't like to overpay for things. The second slide, it's a bit of an overview of what's coming up, really. So why UK smaller companies? Well, it's a very high returning asset class, and I've got some data on that coming up on the next slide. Why this particular trust? Well, we've got a very strong long-term track record of outperformance. The trust also has a very attractive dividend yield. So it has a 4% dividend yield based on the year-end share price. So very attractive for anybody looking for income from their investments. And we're currently trading at a 9 or 10% discount to asset value. So it is a genuine value situation. And then the next point, why now? Well, you know, as you know, hence the events, really, stocks are looking very cheap in the UK and unusually so, really. And we think this moment in time is a real opportunity. So this slide here, I thought I'd just show the very long-term returns. These are annualized returns on a range of asset classes, the kind of things that people typically own within their portfolios. And so if we look at the left-hand column, this is inflation, and this is the average annual UK inflation rate in the UK since 1955, 4.7%. So given the recent fall in the inflation rate in the UK, we're actually around the long-term average. It's not particularly high, it's just an average rate of inflation that we have currently in the UK. And so how have these various investments protected people against that inflation? Well, the next three columns are all various sorts of bonds and fixed income products. So treasury bills, index-linked gilts, long gilts, and they've actually done a pretty good job of retaining, you know, enabling people to protect themselves from inflation and retain their spending power. So typically returning between 6 and 7% per year over the very long run. Then the next column, house price, is slightly better than that. So nearly 8% return annually. And then, of course, we come to equities on the two right-hand side columns. So the FTSE All Shares delivered 11.1% total return per year on average over the long run, so a very good return. But then you get to the final column, which is the UK small cap sector, of 14.2% per year. So a very attractive asset class, really strong returns, and you know, we think it should be part of everybody's portfolio. The next chart is I guess the inevitable price earnings chart for valuations, and this is 15-year data, and the horizontal light blue line shows the average price earnings ratio that the UK small cap sector is traded on over that time period. And as you can see, at the current moment in time, the valuation is sub 10 times price earnings, which is an unusually low level for the sector. And we think that represents a real opportunity, particularly as we now appear to have seen the peak in interest rates, which have been, you know, that increase in interest rates has made making any kind of return on any asset class difficult over the last year or two. But that process appears to have come to an end, and we're hopeful that the certainty that brings can lead to renewed upward trajectory in both markets and valuations. The next slide, this is a discount slide relating to the shares of the investment trust. And as you can see here, the current discount is around 9 or 10%. And what that means in practice is when you're buying the shares, you're buying £1 worth of assets for, you know, 90 to 91 pence. So you're buying the shares at a substantial discount to their asset value. And if you look historically at the trust, pandemics and war in Europe aside, the trust is traded at, on average, around a 5% discount. So if we can make progress back towards that level, that will give investors in the trust a bit of extra return over and above what we can achieve with the portfolio. So it is a genuine value situation at the moment, in both in the market and also in the shares of this particular trust. And so, you know, what have we done in terms of adding value through our investment process and through our stock picking? Well, this chart here shows 10-year performance. The benchmark index is the pink line at the bottom. The two blue lines are, the light blue line is the NAV of the trust, and the dark blue line is the share price total return. And the numbers on the right-hand side show you the return over that time period. And as you can see, we've achieved more than double the return of the benchmark index. And I think part of the reason for that is that the UK small cap sector is, because it's so diverse and under-researched, you can genuinely find businesses that are misunderstood by the market and are materially better quality than people think, and therefore offer much greater upside. And that's our job as fund managers, to sniff out these ideas and make sure we've got enough of them in the portfolio to drive that excess return over the market. And so to achieve that outperformance, have we taken any crazy risks? Well, this chart is a risk return scattergram. It's 5-year data. And up the vertical axis, you have 5-year returns. It's an annualized return. And along the bottom, you have risk as measured by volatility. So you want to be in the top left-hand corner, which is better returns for lower risk. And this trust has been consistently in the top left-hand quadrants whenever we run these numbers, which means that although we are delivering outperformance, we're doing it in a way which is less risky than the vast majority of the peer group. And we think this is a real validation of what we're doing in terms of our investment approach. So in the current markets, with all the volatility, how are we running the portfolio? Well, we're using what we would term a barbell approach. So there's broadly half the portfolio is invested in what we would call more defensive growth businesses. And these are companies that have more certainty over their future revenue and their future level of profitability. And they get that visibility from a couple of areas. And firstly, it's companies that are exposed to more stable areas within the economy, and therefore have certainty in that way. And on the other hand, you have companies that have very long-term contracts. And again, that gives companies a very good visibility over their revenue and profit. So we're keen to have plenty of these companies in the portfolio. Certainly when markets are falling, these stocks tend to outperform. So they've been quite beneficial to us over the last 12 months. The other half of the portfolio is slightly more contrarian. These are good quality cyclical businesses. And by cyclical, I mean companies that are more economically sensitive. And in many cases, these companies are not trading particularly well at the moment, and the next 12 months may be difficult for them. But we think that's more than reflected in the valuations that we're paying for these businesses. In many cases, they're on single-digit price-earnings ratios, but that's also a multiple of quite depressed earnings. And it often pays to be contrarian at certain points in the cycle, because as soon as the market gets any hint of a more positive outlook, the first thing that happens is a re-rating. So the multiple of profits that these companies trade on increases, and that gives you positive returns. And then as the economy recovers, you get a recovery in profitability and earnings as well. So there is potential for outperformance from these businesses at the right phase in the market. Now, you know, because I think the UK economy is slightly misunderstood, I think things are nowhere near as bad as you believe if you just read the newspapers or listen to the news on the BBC. We have full employment, companies are well capitalised, consumer balance sheets in aggregate are actually in a pretty good state. So we don't think we're in for a particularly bad recession, and we're hopeful that over time recovery will start to emerge. And therefore we want to make sure we've got enough in these names to drive performance as that happens. So we're comfortable running the barbell position, the barbell portfolio at the current time. And so in summary, the UK small cap sector is an excellent sector to be exposed to. It's driven very strong returns over the long run. So we think it's a very attractive asset class. Valuations at the moment are very low, and we think that represents a significant opportunity for people. The trust has a really attractive 4% dividend yield, which will suit anybody looking for income from their investments. And the trust is currently trading at a very wide discount. So not only is the underlying asset class cheap, we believe the shares are also cheap as well. So it's effectively a double discount that people can get currently by buying the shares in the trust. And that's the end of the presentation.
Thank you very much, Jonathan. That was really fascinating. We've had loads of questions coming in, so thank you everybody for sending those in. There's still plenty of time to do so. We'll move on to Q&A now, but please keep them coming in. I'll try to collate them, put them together. One of the things I think both of you agree on, and lots of the questions being focused on, is valuations. The UK is obviously facing headwinds. Valuations are cheap because of this. What do you think are sort of the key factors behind the UK being so cheap, and what are the potential catalysts for this to turn around? Because it's been this way for a little while. We've just had Jonathan. We'll give you a chance to catch your breath just a bit. I'll put this one to James first, please.
I mean, there's been a perfect storm. I remember June 2016. I do open-ended money as well as closed-ended money, and I had a German investor saying to me, the UK is going to have a dreadful Brexit. I want to sell all my UK shares. So I said, well, can I come and see you? And he's in Germany, and he said, yes, you can, but it won't do you any good. And sure enough, he did sell all his shares, as did other people, other European holders of UK assets, and the Americans were selling UK assets. But what was worse than that was the UK people sold assets, sold down their holdings. So some of the big life companies that would normally have 30 or 40% in the UK, they're down to sub 10 in lots of cases now. At the same time, the pension fund industry, when I started at Henderson's in 1982, I think we were 60% UK on the equity portfolio. It went down into 10% stages, and now it would be well sub 10 again. So that they all sold. Also, people deferred making decisions because they didn't know what Brexit held for them. So there's been huge selling, and some of the buying that's come has been overseas buying, and they've concentrated on the big companies that they know that they've got equivalent companies in America. So the likes of Astra or something, they're much more comfortable buying that than they are buying further down the market cap scale. So that has been a sort of perfect storm. The pension industry, maybe that they've sold down to the level where they can only now increase, whether they're made to increase by the authorities in some way, or whether they just see everyone else doing quite well out of that area and watching one another and thinking, I better have a bit more than him, and you get a sort of bit of traction going. And the life industry, yes, they can't get much lower, and actually people are really wanting to talk to us at the moment about the UK. They're slightly at the end of the meeting saying, that was very interesting, James. You always know when people say very interesting to you, they mean thank you, but no thank you. But they're wanting to have the meeting, which is a bit of a change. My diary is full of people wanting to talk UK small cap, but we're not quite getting them. But it just needs a little bit of confidence, and it can start to snowball. And there aren't the sellers there. What's the catalyst that makes it happen? Well, we'll know what the catalyst is 3 years after the catalyst has actually done it. It might have happened. It could have happened when people thought rates weren't going up anymore. We have seen interest coming down into down the market cap a bit, and the last few weeks have been the best period for a while. So it might even be happening now. But it's a huge wall of worry to climb, and it won't be a sort of straight climb. There will be sort of ups and downs on the way. But there is a feeling I have now that when I look down on the open-ended side, for instance, who's going to sell the trust now? I think all the people that are there are committed. They have seen the story. Will they add? Well, they might slowly add, and will we get new buyers in? a bit after that, we might get new buyers in. So I think that's how it happens. It's quite difficult to rationalise and say this is the macro event that makes it happen. I don't think it is a macro event. I think it has been about swings of capital, and the big one was Brexit, what it did for outflows in the UK, both domestically, the domestic investor and the overseas investor, has led to the downgrade of the UK compared to other markets. And that sort of is quite clear. Jonathan showed a slide of the rating that the UK now is on, and that is at a discount to everywhere now.
Interesting, thank you. And well done to both of you for getting 27 minutes into a UK presentation without mentioning the Brexit word. I will just pass that question over to Jonathan now. Do you think it is this case of just lots of issues creating more sellers than buyers, or is there anything more structural underneath? And perhaps moving on to the catalyst, just to pick up a couple of the questions we've had in, do you think something like a Prime Minister Starmer, dare we say it, could be something that sort of changes the needle, just resets that history, or something like the British ISA, those sort of targeted ISAs, pension funds being required to invest a certain percentage in the UK? We talked about this just before coming in. Do you think, Jonathan, that could be a catalyst that could spark something?
Yeah, all those things you've listed there. I don't know about the change of government. I'm not sure it'll make too much difference. I think certainly that the Starmer is talking in quite a business-friendly way, and if you look back to the Blair governments, it was actually quite a good time in stock markets. So I'm not convinced the change of government's particularly material when it comes to market levels. Certainly, regulatory changes around pension asset allocation and the potential for British ISA would certainly be helpful, but there's no guarantee those things will happen. Certainly, when we're looking for turning points in markets, there's a couple of things we look for. Firstly, a pickup in takeover activity. So even if institutional investors aren't buying, corporates and private equity buyers can see the value, and we've seen a significant increase in takeover bids throughout the UK small cap area over the last 12 months or so. So people can see the value in UK and are doing it by buying entire businesses. The second thing is, are companies still falling when they have profit warnings? Well, certainly over the last few weeks, we've seen businesses with earnings downgrades, particularly in the cyclical sectors, not falling when they've had earnings downgrades. And that means that investors are starting to look through the current difficulty to better times ahead. And that's certainly been the case recently. And certainly the market has started to gain momentum. I mean, if you look at the performance of the FTSE 250 over the last couple of weeks, it's been particularly strong. And that feeds through to people's perception of the market, and you get this shift from fear to greed, and you get this fear of missing out. So markets can gain their own momentum over time, and we're hopeful that potentially with the interest rate cycle having ended or appears to have topped out, that it could herald the beginning of a new bull market, which is certainly something we're hopeful about.
Yeah, it's interesting. I mean, one of the questions we got from our audience sort of earlier on was about the M&A boom and whether sort of higher interest rates had killed that off a bit. But with the news we got yesterday with the Hotel Chocolat bids, it shows that M&A is still live and kicking, especially at such a premium. Do you think that could be a market force going forward, that continued M&A, as international investors begin to recognise the value? And then following on from that, do you think that could kick a cycle of IPOs happening? Like, the market's been sort of dead on arrival for a little while. Is there a chance that the IPO market could come back to life as well, which could create some opportunities for both of your portfolios? I think I'll go Jonathan first on that one, to give you a chance to have a glass of water.
Certainly we're continuing to see takeover bids. As you mentioned, Hotel Chocolat got bid for yesterday, and we've had a number of bids within the portfolio over the last few months. So I think that as long as stocks are cheap, that will continue. So what's the second part of the question? The
IPO market, yeah.
Big part. I mean, we'll need to see a bit more market momentum, I think. And there's been very few IPOs over the last 2 years. I mean, we don't really play much in the IPO market. if there's a good reason why a company's raising capital on the market, then that's of interest to us. But if it's just somebody cashing their chips in and trying to sell out, then that's of much less interest to us. But I'm sure we'll see a re-emergence of that over the coming months. I'm pretty sure the brokers will be keen to generate some business in that way. So yeah, I would expect to see that return.
And James, how about yourself? Have you sort of been a beneficiary of much M&A activity in the portfolio?
Sorry about that. Yes, no, there has been, but very frustrating. They're not paying big enough prices. People are so keen to get the cash and liquidity. The people buying are getting the best of the deals. So it's very with mixed feelings that I have seen bids coming in for the portfolio at the moment. We sometimes try and stand out for higher prices, but it's I think the buyers will be doing best. That's usually what happens. The takeovers that are done when the market's low prove to be very worthwhile. What's the academic stuff that shows takeovers don't add value? That's because you'll see takeover activity happening at the top of the market, and those deals don't work. But I think people that are making acquisitions now will look very clever in a few years' time. Sorry about the coughing.
No problem. I'm sorry you're struggling so much. Going back to some of the listing rules, we've talked about the changes in pensions and British ISAs, etc. But do you think there's the opportunity to rewrite some of the rules on listing companies, changing some directors, remuneration, things that could sort of spark the market back to life? There's been a lot of conversation in the press about the US taking all of the things, especially with ARM going over there, drew a lot of headlines. Could a revamping of the rules potentially coming next year after, help the UK stock market at all?
Well, I mean, we already have the AIM market, which is ideal for smaller growing businesses. I mean, it's cheaper to list on AIM. There are less regulations around it, and it's certainly much cheaper to raise additional capital once you're listed on AIM. So I'm not sure it's entirely necessary, and I'm always slightly wary of watering down rules. It can lead to its own problems. I think people choosing the US at the moment because it can, realize a higher valuation for their business when they sell it. So, as we've seen the market recovery over here, I think that will drive its own momentum in terms of companies wanting to list it.
Thank you.
Yes, I think that's right. I mean, people are quite hard on the UK market at the moment, but we forget 2020. A lot of companies, a pub company in 2020 had to close its door. No one was allowed in to have a drink, and not surprisingly, that some of them were running out of money. Things like Wetherspoons had accelerated rights issues. They got capital in within 48 hours of trying to do it, and that was the market working very well. I mean, a development capitalist would not have done that. You'd have had to written 101 papers about why you needed money, etc., etc. It was that the market showed that actually capital is forthcoming in a very necessary, good way. So I think some companies that are complaining about their share prices now, I can understand their frustrations, and I can see why they don't particularly like AIM and in the short term, but they forget that over the long term, AIM has been a good place to raise money, and it was tested in that early summer of 2020, and it did work. So I'm trying to defend AIM to people. Yes, it's frustrating at the moment, but that's markets, and you just have to keep telling your story, keep coming through with the earnings, keep the dividend going up if you can, and you'll get see investor interest over time build, and that will allow you, when you've got a good plan, to use that market to expand your business. So
yeah,
I think we are being hard, but we do need to be telling the story and encouraging companies to use AIM. As Jonathan said, the regulations are a lighter touch, but they are of such that they do protect investors to a certain extent, and that's I think it actually gets the balance much of the time quite right on AIM.
Yeah, I've got one more technical question on rules and regs, and then we'll switch gears a little bit. Just for James in particular, are you, with that 44% of the portfolio on the AIM market, are you concerned about any of the changes in the inheritance tax rules? That has been a bit of a tailwind for that market in a couple of names.
Yes, there is that, and it would I think initially lead to a little bit of sell-off, but good businesses, capital will find it regardless. So the other side of that, it could be that we worry about that. Yet at the same time, if the new pension rules mean you have to be in unquoteds for 5% of your portfolio, let's say, AIM would be counted as unquoted in that rule. So suddenly you've got more regulated good market. It'll never be 5% pension funds, but if it would move towards that, AIM would suddenly see an influx of interest from buyers. I think for me, don't worry about either. Just try and buy good businesses, and if AIM interest does keep dying down, we will see more takeovers. But I'm hoping that's not the solution. I'm hoping the solution is going to be interest genuinely growing amongst UK investors in UK businesses.
Yeah, great, thank you. I promise I will switch gears. I will now move on to dividends and income generation, if that's okay, Jonathan. You paid out 4% from share price, quite a good income to get from smaller companies, traditionally a growth asset. How is that sort of underlying generation going for you at the moment? How easy is it to hit that from naturally from the portfolio with valuations where they are?
Yeah, the portfolio is yielding about 3% at the moment. So we to shareholders, and we also pay currently around 1% out of capital. And we like that solution. We don't want to be forced into companies just because they have a high yield. I think that would steer us towards businesses that have less growth and potentially less attractive from a total return perspective. So we target businesses with the best total return, and we top up the yield with the payments out of capital. So it looks fine to us at the moment. We've got huge reserves. We can continue to do that for many years. So that 4% yield is totally sustainable.
And James, what's your view on the sort of dividend market at the moment? Is that something
I run income funds, Lord Venture and Lowland, and I don't really look at income in the same way for HOT. It falls out, and the board keep nudging the dividend up. Why don't I look at it particularly? I see HOT as a mixer, so I think people could own Lord Venture and HOT, and they wouldn't have much crossover in underlying holdings. There'd be a lot of different names that they perhaps hadn't heard of in the HOT portfolio that I think are the next generation of exciting UK companies. And because they're probably not paying dividends of any scale because they're reinvesting in their business. I think income investing has its own disciplines and is actually hasn't been really pointing in the right direction in recent years, but actually this year slightly has. I mean, the smaller companies I've had taken over this year have often been the better dividend paying companies, like something like K3, for instance. That is because the early takeover buyers are wanting solid revenue companies. They're looking to keep risk down. They're looking for that company that's got the earnings moving and is generating cash. And remember, a dividend is a cash payment, so it's about cash generation, and cash generation means slightly lower risk. So actually, it has been pushing me in the right direction on income funds in the smaller company area. But I think this doesn't last. The next phase will be that actually some of the higher growth things that aren't paying dividends are on the wrong ratings. They need to prove it that they are those high growth things, and either the share price will recover or move forward, or we will see takeovers in that area too. So that's a rather sort of roundabout way of saying income revenue accounts in income funds are looking quite good. We're seeing quite a lot of specials still coming through. And I start every year saying to boards, I'm not sure how much revenue growth there's going to be this year, and being pleasantly surprised, partially because of specials. And I think that continues. The companies, I know 2 or 3 that are quietly thinking they'll be paying specials this year, and that will, on top of an ordinary that's growing at least in line with inflation.
Yeah, very attractive. And then perhaps moving on to gearing, both of you have highlighted the value opportunity. One of the great advantages in investment trust is the ability to gear. Jonathan, what are you doing with are you taking advantage of that by adding gearing to the trust?
Yes, we are. We've been ungeared for quite a few years. And over the last few months, we've begun to introduce gearing into the trust. So we're, I think, 4.8% geared as of today. And that decision's been based around 2 things. So firstly, the underlying valuations of shares, they just look very, very cheap whenever we look through the portfolio. And then the interest rate cycle, which we feel much more confidence has come to an end now, and that increased certainty should be beneficial for markets going forward. So yes, we've introduced some gearing, and as we get more data points, as we gain more confidence, then I think that's probably likely to increase as we move forward.
James, yourself?
Yeah, no, I'm double-digit geared across all my trusts, and the gearing has gone up. So something like Lowland is nearly 15% geared. HOT is 11, and I'm wanting to be a net buyer, and I think it's funny to debate this gearing. I've run Lowland since 1990, and we used to take gearing up to 25%, and it never really worried shareholders. Somewhere along the line, and I think it came with sort of more governance in the trust sector, the trust sector has become much more conservative on gearing. I suppose the split crisis too of the early 2000s might have coloured it and brought gearing down. And it's more difficult to persuade people that it's legitimate to be running with higher levels of gearing after a while. But actually, look at Jonathan's numbers on the return on equity against the return on fixed interest. You should, on the whole, be geared most of the time, in my view. And actually, that's where I am. I'm always partially geared, because I do believe over time, and all back testing would show this, that equity outperforms the costs of borrowing. There'll be periods when it feels quite tough, but if you've throttled off a bit, you can then step it up. So yeah, no, definitely one of the great advantages of the investment trust, the closed-end structure, and not buying back shares helps that, because you're not looking over your shoulder thinking you're going to have to be selling shares because of outflows. You can sit and use the gearing, and because you never know when the market's turn. Both of us just talked about whether the last 3 weeks being nice. So this might have been a market turn, and what's actually happened? Well, yes, base rates might not be going up anymore, but it's difficult to justify to be firm about these things. So for me, you should always have gearing, and you'll be surprised. And actually, the initial move from the bottom is, if you miss that, you're always going to be on the back foot through the rest of the cycle. Better to be geared now and catch that move. Then you've got the confidence to be a net investor. The gearing falls as the asset price goes up, and you can stay on the front foot investing. So I'm positive. I always have the same conversation with boards. I always say to boards, let's increase the gearing another 5%, and the board goes, yeah, I sort of agree with you, but James, let's do 2 or 3%. So that's the conversation. And I've actually with boards at the moment, they're actually they're positive about us moving forward and being a net investor, and that's a good place to be.
Yeah, no, it's interesting. Actually, given you discussed boards, I'll sort of jump over to this question. We've seen a huge amount of corporate activity in the investment trust world. What conversations are you having with boards about things like buybacks and stuff like that? For some of us who get notifications on RNSs every day, comes to 4:30 and it's just ping, ping, ping. Like, are your boards sort of seeing the value in your own share prices with these discounts?
Shall I go first on that? Because I'm probably more difficult on this than other people. I think it's a mistake to be buying back. I think it makes it, particularly in the smaller company area, it makes you semi-open-ended. And I run open-ended funds. It's very difficult to be investing in proper smaller companies in the open-ended arena at the moment because of the inflows and the outflows and the lack of liquidity. Often the best opportunities at the moment are in the least liquid areas of the market because everyone's got this focus on liquidity. The risk managers and the investment houses are all telling managers to be very wary about being in illiquid stocks, and that's led to the liquid stocks falling to valuations that are extraordinary. And the investment trusts have great ability, scope to utilize that. So for HOT, it's very exciting because we've got a small trust, £100 million trust. We can buy these illiquid things at really knockdown prices. We can't if we were buying back shares. And people say, oh, if you think your portfolio is good, why not buy it at a 15 discount? Well, you buy it at a 15 discount, but then you have to sell some of the underlying shares. Actually, so it was not actually a 15 discount. You've got the costs of dealing and everything else. And yes, the share price might go up, but you've actually had to sell shares to meet that discount. You're not actually participating with it. So it's a theoretical argument. It's marginally true at the time. It's not true in the long term. You'd be much better to have bought good companies and watch the share price keep appreciating over time. And I think if we keep articulating what we're doing, we keep telling people what we're doing and do what we're doing, retail picks up, and it's just to retail buyers that will drive away discounts. I've got one fund on a modest premium at the moment, and that's usually where the cycle starts. It does more in big companies, Lord of Venture. As confidence grows, it won't just be in the bigger companies. It will filter down to the smaller companies, and we'll see the smaller company trusts discounts narrow too. This is in that sense, this is a sort of normal discount cycle. At this stage, small companies do fall to big discounts, and by the end of the cycle, they'll be up near asset value.
Jonathan, your thoughts on sort of discounts and?
I think we already hand back capital, but as part of the 4% dividend yield, we do hand back capital to investors to achieve that yield. So we are handing back capital at par value. So that's part of it. The other factor we have to look at is the size of the trust and liquidity. And if you shrink a trust too much, it becomes less attractive to certain investors, and it can actually be counterproductive in terms of managing the discount. So we have historically bought back shares, but the board at the moment is less keen on that, and I think that's entirely justified.
Yeah, and actually liquidity was the question that we skipped over. So both of you have touched on that already, but Jonathan, I'll just extend the question to you about liquidity in the small cap space. How is it at the moment? Any signs of it sort of moving in one direction or the other?
It's okay. It is easier to sell shares, to buy shares rather than sell them at the moment, because there's a lot of open-ended funds in net outflow currently, but that'll shift over time. We don't invest in microcap, so we haven't experienced any particular difficulties in either building or exiting positions. It's not really been an issue for us.
Yeah. And I mean, James, you spoke about in the presentation, your sort of slightly smaller size helps you out a bit there.
Yes, it certainly allows us to buy that illiquid macro cap in HOT, and that it is exciting because it is a sort of abandoned area. I think on investment trust liquidity, it is about retail investors. They will be replacing the wealth manager on the register. It's happening. For most of that buying is through an ISA. An ISA is maximum 20,000. All these trusts are perfectly liquid for retail investors. So it's slightly the liquidity interest is slightly something that the brokers go on about, but it's not really real for the great majority of users of investment trusts now.
Yeah, that's interesting. Thank you. We've got sort of just a few minutes to go, really. So we're getting towards the end of our questions and our time. We'll try and finish on a positive note and ask you perhaps what your most exciting sector is at the moment, the most exciting area that you're investing in, where you're seeing the best outlook and the best valuation opportunities. I don't mind who wishes to go first. You're welcome to, but
I'll have a go because I dive with the same as yours, Jonathan. Where am I most excited for the most exciting areas? I think these alternative energy companies. I think we have got hydrogen will play a bigger part in the future. Everyone's hit these investment sentiment to these stocks has been poor. Look, too much was promised too quickly a few years ago. It's going to take time, but the defossilization of the economy is happening. It is slowly happening, and companies like Ceres, AFC, ITM, some of those will be substantially bigger companies in 10 years' time as we move towards a greener energy, and it's they're the wrong sort of concept for the market at the moment. People, as I said, people wanting companies with genuine earnings today. They're less comfortable projecting forward, and it's very difficult to project forward of when these earnings of these companies are going to come through. But I think the UK is making strides in that area. Fuel cells are gaining traction, and I think there'll be really good returns to be made in the area.
Very exciting, thank you. And Jonathan, any areas that you're particularly excited about at the moment?
Well, when we look through the portfolio, everything looks cheap at the moment, but I think probably the biggest shift we've seen is the valuation of some of the technology stocks, which have gone from trading on 50 times earnings during the pandemic to high teens multiples now, which is very attractive to us. I mean, a lot of these businesses have multi-year growth opportunities ahead of them, and you can value them on normal metrics now. So it's been an area that we've added to over the last 12 months or so.
Brilliant. We have gone through the questions now. I'm sure we can stick around and do a couple more, but I think what we might be able to do is break a couple of minutes early for lunch and say to both Jonathan and James, thank you both very much for your time today. I think it's been really interesting. It's a proper rundown of the UK, gone through all the valuations and everything going on in the market. So thank you both very much for your time. For anybody still listening, see we've kept really good viewership rates up. We will put these videos on the website afterwards. Feel free to add the trust to your watch list and go through the fun notes. And otherwise, have a lovely afternoon and enjoy your weekend.
Thank you very much.
Thank you.
Thanks very much.
Good to talk to you all. Thank you.
Likewise. Thank you. Goodbye.